Hello, welcome to a wonderful opportunity to hear from two titans of finance. This is Mark Skousen. I'm the producer of FreedomFest. Welcome all Freedom Festers. This is a first event we've ever done, a pre-conference event, and we did it because this was the only opportunity for us to engage live through modern technology with the twin titans of finance, Jeremy Siegel, the Wizard of Wharton from the Wharton School, and also Burt Malkiel, who's professor emeritus of finance at Princeton University. So welcome, gentlemen. Glad to have you here. And let me also introduce Alex Green, who's the chief investment strategist at the Oxford Club, a longtime friend and a big fan of Freedom Fest. He comes every year. And as you know, we have a 3.5 day investment conference at Freedom Fest. And in 2008, we had the opportunity of having both Jeremy Siegel and Burt Malkiel come and speak right during the financial crisis, actually right before it really exploded, if you will, because our conference is always in July and the financial crisis occurred in 2008. So I wanted to start off by asking both of our featured speakers, first with Jeremy and then Burt, tell us, are we going to experience another 2008 financial crisis, or are those days behind us? Jeremy, why don't you start?
Well, those days, I think, are behind us. I do not see anything in the banking system now that compares with 2008. I know we had SVB, and that raised fears, but the balance sheets of the big banks, and that was what was impaired so dramatically by their, going into the subprime mortgages and leveraging themselves so highly in the real estate area at that particular time. That is gone from all the big banks. Now, the small intermediary banks, we know about the problems of commercial real estate, et cetera, but the problem is, is a mosquito relative to an elephant, in my opinion, in terms of what sort of banking problems we have. That said, we're going to get a lot of consolidation, I think, in banking. I think we have, way more banks than any other country in the world per capita. A lot of the small ones will probably have to merge, especially those that had gone into commercial office real estate. Office space is what's the problem. The rest of commercial space is doing extremely well. But if you went into the office space, you're going to have problems, and I think you're going to get mergers there. But I don't think that will precipitate any sort of banking crisis.
So, Burt, give us your opinion. I know both of you in your books write about the 2008 financial crisis. Is this just a unique event, or are we going through another financial crisis in the future? We just don't know what it is.
Well, first of all, I agree with Jeremy that I do not see a banking crisis such that we've experienced in 2008. I think the banks have far more capital than they had then, and I think it is very unlikely. Having said that, to answer your question, are we likely to have some other crisis in the future? I would say absolutely. Something will come that we don't know about from left field, whether it's the Sam Bankman-Fried crisis with cryptocurrencies, whether it's some political international event. We have had a history of crises. I am sure we will have some in the future. I don't know what they will be. You don't know what they will be. But clearly, we live in a very uncertain world. And I think it would be a mistake to simply assume that we're going to have wonderful stability in the future.
The 1 million Dow that is being predicted, right? Maybe there'll be a lot of ups and
What
downs
year,
on the way.
Mark?
Right.
So let me, or Alex, did you want to ask a question?
Yeah, I sort of touching on their themes of whether we have a crisis ahead and what it might be. Of course, nobody saw the crash of '87 coming. No one saw Saddam's invasion of Kuwait in 1990. No one saw Jeremy saw the .com bust because he wrote a beautiful editorial in the Wall Street Journal right at the very peak, warning people that the valuations were unsustainable. But 9/11.
By the way, Alec, let me interrupt real quickly because Burt Malkiel also was very pressing on this because I was in Burt. I don't know if you remember this, but I was in your office in late 1999, and you showed me a chart of either the NASDAQ or the S&P 500 and how it was hyperbolic. And we both looked at each other and we said, sell. I mean, it was really, so it's interesting that both of our guests here today have done a decent job of predicting an exception to your rule, Alex.
Right. Well, they didn't predict the crash of '87. They didn't predict Saddam going into Iraq, which led to a bear market. They didn't predict the 9/11. They didn't predict the pandemic. They didn't predict even the housing boom and bust. Took the Federal Reserve by surprise. Alan Greenspan, he was already the ex-chairman of the Fed by then, said he still couldn't wrap his head around it even after it happened. So, I mean, there are all kinds of things out there. And so that leads into my question here, which is, you have a great optimism about the long-term outlook for equities. I mean, both of you agree that people should have a substantial portion of their net worth in stocks and that the outlook for stocks long-term is positive. When you think about the climate situation, the metastasizing federal debt, the high interest rates and inflation, the geopolitical problems with Russia and China. What do you say to people out there who say, I want to be long-term optimistic about equities and the economy and the state of the world, but I can't, given all the problems? How do you answer people who just say, I lack that long-term optimism to be a long-term equity holder?
Jeremy, why don't you go ahead on that one?
I'll go first. Well, first of all, really great question, Alex. But on that, one reason I like equities is, you talk about inflation, and everyone else studies have shown that in the long run, stocks are fantastic hedges against, not in the short run, year by year. But over the long run, and I think you're going to show a chart on that, Mark, a little bit later, that stocks being claims on real assets instead of paper assets that the government puts out can overcome inflation very, very well in the long run. So now, as far as the other political risks that are concerned, I go back in history. We've had 2 world wars. That's, will there be a third, and what would it be? I mean, I used to think terrorism attack would be one thing, but now, or could it be bioterrorism? I think there was a op-ed in today's Wall Street Journal about what the next possible war is going to be fought with. I mean, all we've gone through all that in the past. It's always been with us. Let me tell you, I mean, I don't really know what would retain value if the apocalypse came. I mean, even gold, certainly not government bonds. I think they'd go before equities maybe, and claims on real assets. So, there's always those risks. We've always had them. And over the last, 250 years, we've always overcome them.
Let's look at, let's start with this chart. John, if you can pull up our chart, the first chart that I have, which shows the volatility of the market. Can we do that? Okay, the next chart. So I thought you'd get a kick out of this, both Jeremy and Burt. if you look at the short-term 1-year changes in the marketplace, it really does look chaotic, volatile, and totally unpredictable, right? Right. And Wall Street exaggerates everything. I mean, the stock market is just all over the place according to this chart. And actually, in one of the economics textbooks that I was looking at, they actually showed this chart. What they didn't show was the next chart, which is from Jeremy Siegel's book, Stocks for the Long Run. Let's look at that. So here, this shows you what you were talking about, Jeremy. In the short run, it's kind of unpredictable. It looks chaotic. Year by year, it changes. But look at this long term. Even the Great Depression that you talked about and the wars and so forth, there are a little blip in the long-term upward trend in the stock market. So tell us why you conceived of this chart and how influential has this chart been to the investment world?
It's the first chart I always show. This was a chart. I was asked by Marshall Bloom at the Wharton School to do New York Stock Exchange for its 200th anniversary in the late 1980s, wanted to do a study. And he asked Marshall Bloom and myself, and I was in charge of doing historical returns. He did policy. And I started saying, listen, I'm going to look at all the major asset classes, stocks, bonds, bills, gold, and the dollar after inflation, total returns. So including all cash dividends. And it took me almost 3 years to actually collect all this data and process it. And I remember when this chart came out on my computer and I said, wow. I said, this is a story. And my colleague said, this is a story. You should tell this story. In the short run, stocks are the most volatile asset class, but in the long run, they're the most stable asset class. 6.7%
even more so
a year.
than bonds. One of the things you said in your book, which really shocked a lot of people, is that bonds are more risky than stocks. That's a shock.
In the long run, in purchasing power, yes. In the short run, they're safer, and certainly bills are safer. But unless you buy tips, and you're getting a real low yield on those tips, of course, the inflation uncertainty overcomes the other certainties of bonds that actually make stocks more stable as a long-term investment. Let me just mention, we just put out the 6th edition of Stocks for the Long Run. I went back to the first one 30 years ago and I looked up what was my return. It was 6.7% a year. So despite everything that's happened in the last 30 years, and Alex has named a number of them, if not all of them, isn't it remarkable that the real return of the last 30 years has been exactly the same as a 6.7% compound annual real return on stocks that has existed over the last 220 years?
So,
Burt,
Burt,
Jeremy knows, I am
go ahead,
a big
Burt.
believer in this chart. And as he knows, every time I do a new edition of Random Walk, I ask him for the updated numbers because it's absolutely right. This is the right thing for the long run. This is the asset that people should use in accumulating a retirement fund. With respect to the question of could there apocalypse happen, whether it's bioterrorism, could we have a nuclear holocaust that ends the world? Sure. But the fact that I'm overweighted in equities will be the least of our problems when those things happen. And I'm not sure that it would alter my view. Now, let me mention one other thing, because I think the chart you put up about the volatility is very important. And to understand that for an accumulator, the volatility helps one to the extent that one is a regular saver, putting, let's say, $100 a month little over $20 a week. The giving up the soy latte at Starbucks one day a week. To the extent that one is able to do that, one takes advantage of dollar cost averaging. And what that means is during the periods when the market is down, your $100 buys more stocks than during the periods when the market is running away on the upside. And I've calculated that even during decades when the market has been a terrible place to be, the person who dollar cost averaged actually made money. And let me tell you those two periods. We had the stagflation period from 1968 into the 1970s. You had a decade where the stock market ended up exactly where it began, and the dollar cost averager made a nominal rate of return of almost 6%. Take another decade that was a terrible decade for stocks, the beginning of the end of the dot-com boom, January of 2000. Over the next 10, 11 years, the market went nowhere. It ended up exactly where it began, but the dollar cost averager made a nominal rate of return of something around 5.5%. So this is extremely important for accumulators. It's another reason why you want to be in equities and where the volatility can be your friend rather than the enemy. So let me just put one postscript on that. Dollar cost averaging is not right for people who are living off their retirement funds, who have to take required minimum distributions. This is not the strategy. That strategy is, while I believe fully in equities, as you get to the point where you're going to have to take money out, I want you to reinvest your dividends in perfectly safe assets so that you know that with your required minimum distributions, you're going to be able to have the dollars that you anticipated, because you don't want a dollar cost average on the way out, because then when the markets are down, you're selling more of your equities, and it's the wrong strategy.
Yeah, your dollar cost averaging idea and high savings rates is really telling. It's kind of an anti-Keynesian perspective in terms of you're very pro-saving, which I think is important in a consumer crazy society. But and 401k plans, this is perfect for people who have money taken out of their paycheck every 2 weeks and put these in. And that's what's being done. And unfortunately, that's not what's being done in Social Security. This is the great defect of Social Security, because if I'm on Social Security right now and getting $3,800 a month, but if I had been able to invest in this chart that Jeremy Siegel has shown, I'd be getting $10,000 a month. A big difference. So that's an example of a policy that we have pursued in this country that has been kind of anti-saving and pro-consumption over the long term. Now, I do want to raise another important issue here, and this is that in both your books, Stocks for the Long Run and A Random Walk Down Wall Street, you pretty much exclusively talk about the U.S. stock market. Yes, you occasionally talk about other markets, but this chart is Wall Street. It's not Latin America. It's not the Middle East. It's not Venezuela. It's not Europe. It's not Asia. And so I wanted to ask you, would dollar cost averaging really work in the Japanese Nikkei index, which has been in a bear market? It has not even reached its previous high in over 30 years. You had a bear market that didn't last 10 years. It lasts like 30 years. So Burt, what's your response to that?
Yes, it absolutely does. The Japanese market has not been like the US market, and it has not been as good a result in the long run. But again, the people who bought when the Nikkei was 40,000 lost money, but the dollar cost averager also bought stocks in Japan when the Nikkei was 15,000. And this is actually a perfect example where even in the Japanese market, which has not been good, it's been exactly the right thing to do. And in general, we live in the United States. We use dollars for the goods that we purchase. We do want to be largely U.S. investors, but we also absolutely should have some international diversification. And I would say that particularly today, when international markets are far less richly valued than the US market. So yes, I want to be a US investor. I'm largely a US investor in my own portfolio, but I also do have international stocks. And I absolutely believe that people should supplement a United States index fund, which is the vehicle that I would use for my dollar cost averaging, with an index fund of non-US stocks, the so-called ACWI index ex-US.
Jeremy, I would like to follow up with the question about American exceptionalism. There was a book written in the year 2000 called Triumph of the Optimist, and they showed that pretty much all the 34 stock country funds that they focused on, all of them had an upward trend, maybe Japan being an exception. But and of course, even then, throughout the 20th century and into the 21st century, the US market is outperformed. So why is that? What is it about the United States that is unique? You know, this is the 30th anniversary or 300th anniversary of Adam Smith. Are we the country that has adopted more than any other country free market capitalism? Is that the reason for American exceptionalism?
Well, two parts. And one thing I want to say is I'm glad you brought up Dimson, Staunton, and Marsh, Triumph of the Optimists, because they have traced, as you said, over 20 stock markets from 1900. Now, I'm not going quite as far back as I did, but so we have 120 years of data on 24 stock markets. Worldwide, the average real return is about 5.5% real in dollars. So even though it doesn't come quite up to the 6.7 in the United States, it still beats bonds by a very, very good margin, even in the United States. And in every country they examine, stocks beat bonds in that particular country. I mean, some of the lowest countries were 3.5%, 4% real over 120 years, and that's pretty much what we've gotten in bonds. And by the way, most of the big bond returns are we can't get 3.5% anymore. Tips are 1.2, so 1.5 maybe right now. So, you know, yes, real returns abroad generally are lower. U.S. is not number one in the last 120 years. Might shock you it was actually South Africa and in dollars, and the reason is the market was so low all the time because no one thought whatever
value investing.
Yeah, value investing worked on that.
But there is a bias, Jeremy, in that whole study because they leave out Venezuela, they leave out Argentina. In fact, there's not a single Latin American country in that survey. There's no country, Israel is not in there. None of the Arab countries are in there. In fact, the only Asian country is Japan. That was the only one that had a legitimate stock market during that time period, because the rest of the countries, they adopted socialism, like Russia, closing the stock exchange and so on. So isn't there an upward bias in that study?
Well, you're right. It's called survival bias, by picking those stock markets that had, existed all that time. And we know, for instance, Russia closed down its stock markets at the Russian Revolution in 1917, and then reinstituted them when communism fell. Same thing happened in China when it went communist, and then reinstituted. So you had gaps where everything was, in fact, expropriated. So you're absolutely right. So here I'm thinking of the Western democracies, which even the hyperinflation that hit Germany, stocks have still, because you held real assets, actually still outperform. So you're right. It has a bias towards the Western democracies and the United States, Canada. Again, we do actually have South Africa over that 120-year time period. But go to the next part. Yes, American exceptionalism. And Dimpson himself has just written an article in the last year documenting American exceptionalism. And I think it is there. I think it's not just capitalism, it's innovation. I mean, take a look at why have we done so much better over the last 15 years than the other countries in the world? Well, you take a look at all the big tech companies, and almost all of them are US. I mean, all
Google, Amazon, Facebook.
Yeah, Microsoft. I mean, if you go up and down, and that's Apple. All innovation of Americans. I think America, more than any other country, we almost we worship the innovators and the disruptors. Others,
the American dream,
particularly, in particular, some of the Eastern society, you don't disrupt. You do a great job, but you don't disrupt. Now that there are exceptions to that, but in the U.S., we will cheer if a company comes in and busts IBM, and many did, or General Motors. In other countries, in China, you don't want to bust the automakers. That's socially not good. You put people out of work, politically, et cetera, and so on. It's a different mindset.
Jeremy, I don't know if Alex or who showed me this, but they had a list of all the companies 50 years ago in France, the biggest 50 companies, and compared them to today, and they're almost all the same companies. And then you go to the United States, and they're all different companies.
Right. Yeah, I think that's it. I mean, there's no someone told me that the tech sector in Britain is zero. I mean, it's unbelievable. And one of the reasons, by the way, let's face the fact, one of the reasons why international investing, and I'm particularly Europe, has been not good over the last 10 or 15 years, although this year, good, at least so far, but is the fact that they're basically a value continent, and value is not performed well. I mean, that's that has a lot to do with it. They don't have tech. They have some drug manufacturers, and some do some things, but they don't have the tech giants. And we know how important the tech giants have been to the S&P. I mean, what is 90% of this year's return? And since 2008, still a big chunk of that return has been because we've cultivated the tech giants.
Now let's go on to this next chart, which is we're now going to talk about a random walk down Wall Street, and I've often compared it, as Burt knows, with my own book, A Viennese Waltz Down Wall Street. Is the stock market a random walk, a drunken sailor, or is it a dance where you have certain rules, but within those rules you can move around and so forth? Of course, we just showed you the chart that's famous in Stocks for the Long Run. Now we're going to show you a statement, which is the most shocking statement in the history of book writing on finance. And that's your statement that, Burt, you make about short-term changes in stock markets are random and unpredictable. It's like a blindfolded monkey throwing darts. This statement, I believe, is in every edition of your book, right, Burt? Tell us about the reaction to this, where you compared Wall Street money managers and people to to a monkey should do a better job. Tell us the reaction you had to your book.
Well, Mark, when the book was first published, the idea that in fact you would be better off simply buying all the stocks in the market, this was considered naive at best and absolutely stupid at worst. I mean, my book was reviewed in Business Week when it first came out 50 years ago, and it was just cut to shreds. Nobody wants to be mediocre. No high-paid Wall Street analyst likes to be compared to a chimpanzee. The fact is that over 50 years, that idea has absolutely been correct. The Standard & Poor's Corporation has for now more than decades published so-called SPIVA reports, where they compare indexes to the active portfolio managers. And every year, approximately 2/3 of active managers are beaten by the indexes. And the 1/3 that win in one year are not the same as the ones that win in the next year. So that when you compound this over 10, 20 years or more, you find that more than 90% of the active managers are beaten by a simple index fund. I'm not saying that nobody can outperform. There have been a few. There've been Warren Buffett has outperformed over his lifetime. But over the last 10 years, Warren Buffett has underperformed the market. And interestingly enough, when Warren Buffett made his famous bet that a hedge fund manager could not pick 5 hedge funds that would beat his index fund, he won that bet handily. But what people don't realize is not only did the hedge funds underperform, but Buffett himself underperformed. So I'm not saying it's impossible, but I am saying the evidence is so clear that clearly the core of every portfolio ought to be invested in broad-based index funds. I believed it 50 years ago. I believe it even more today than I did when I first wrote those words.
Yeah, it's so true, Burt. And we've got a couple of charts. Let's show the next one, which confirms what you're talking about. This is can professional money managers beat the market? And of course, in one year, a lot of them, majority. Next year, about half. Then it goes down. And by the time you're over 5-year period, nobody has beaten the market. It's pretty amazing. And then you mentioned Warren Buffett. Let's look at the next chart. Keep going. We'll pass on that. This is a picture of the rise of the index funds. Now keep going. I want to go to the Warren Buffett. Yeah, there. Warren Buffett beat the market, but became too big, too much of a cash position. There's a lot of reasons why even he now recommends an index fund. And it's very, you get big enough, it's really tough to beat the market in that respect. So let's go back now to some of these other charts as I went through rather quickly. Modern portfolio theory. Let's look at that because both of you, I believe, are advocates of modern portfolio theory. Harry Markowitz passed away a couple of weeks ago, the father of modern portfolio theory. I I tell my students it has three aspects. High returns are associated with high risk. Investors should not try to beat the market. And investors should diversify their portfolio. Jeremy, you think this is sound doctrine?
Absolutely. I mean, it's been shown. I mean, what Burt saw again. We have Jack Bogle about the same time. We have, of course, Paul Samuelson, perhaps the greatest theoretical economist, finance economist. Writing that famous 1969 article, a challenge to someone should market an S&P 500 fund. And we all know Bogle has told the story many times about he was reviled just like you were, Burton. Mediocrity, didn't get any money at the beginning, and then, of course, grew the Vanguard empire into a multi-trillion-dollar empire of funds where all this advice has now become really accepted. But many people, it's in your genes. They want to try to beat them. I said, yeah, I'll probably fall behind, but I want to try to beat the market. And 90% of them do fall behind.
So, Jeremy and Burt, what do you think of my idea? And I kind of do this myself. I put half my money in an index fund, like the S&P 500, or you might try the Gone Fishing portfolio that Alex Green has developed in his own book, into 10 index funds. And then the other half, or maybe a third, used to speculate on individual stocks. You can't help yourself. What do you say to the people who say, yeah, an index fund is fun, but it's not sexy. It's not conversation in a cocktail party. I want to talk about Tesla. I bought Apple and made 10,000% on my money. What do you say to the people who naturally want to have a gambling mentality, if you will, of winning big time?
Look, it's fine. It's absolutely fine. There is no one who spends one's life studying and working with the stock market who doesn't have something of a gambling instinct. And so what I would say to people is that's absolutely fine. Try to find the next Microsoft, the next Apple. You want to buy NVIDIA, go ahead. Do it if you want. But you can do it with much less risk if the core of your portfolio is indexed. And so I say index the core. And then if you want to go and pick individual stocks, absolutely go and do it. It's fun. I buy some individual stocks myself, but I know I can do it because my important money, the money that I have for retirement, the money that I have put aside for my grandchildren, this is in index funds. And since you've got Harry Markowitz on the screen now, let me also just point out it's another reason for international diversification. Even if the returns are a bit less, what Harry Markowitz showed was that international markets don't always move in lockstep to US markets. And so if you have some international index funds together with your US index funds, you probably will have a little smoother performance. You won't have the money value of your portfolio fluctuate quite as much. And for many people, that allows them to sleep better at night.
Great
I would
counsel.
like to just add for a second that the big question is what fraction should you keep in core, but and what fraction should you play with, so to speak? And of course, that's an individual decision. But I think most of it should be core. And if you want to take 20% or 30%, and play with it. And, I probably guarantee you after 20 years that will not do as well as your core.
Well, in fact, it's fun to watch because I put half in each. And you're right, the index funds outperform my individual stock choice. I don't know if Alex, you've had some big winners from time to time that you hold for a long time, like Netflix and stuff like that. You have a
Right.
question? Is there something
Well,
along these lines?
I want to say that I've been longtime admirers of both of these gentlemen. Completely agree with everything that Burton just said about you can index, you can hold individual stocks, you can trade, have some fun. Just do it in proportion. The foundation of your portfolio is the index funds. You can build that with long-term positions in individual stocks, and if you want to trade a little bit for fun on top of that, you can. I will mention that I've beaten the market in a very odd way. At least I think it's odd because most people seem to not have done this. Is when I first started off in the money management business almost 40 years ago, I tried to learn as much as I could from the great ones, which were Warren Buffett and Peter Lynch and John Templeton and others. And one of the things that Peter Lynch said was that you should, if you like a company's products or services so much that you're an avid customer, then you should consider owning the stock because other people might feel the same way. And I thought about that as some of the companies I really liked. And at the same time I read that, I heard Warren Buffett say the capital gains tax is not a tax on capital gains, it's a tax on transactions. Whereas if you own companies, you don't sell them, you don't owe any tax. And so I thought, well, what a wonderful thing it would be to buy the companies that you like and just never sell them. Well, I read this 30 years ago, and I'm happy to say that for 30 years, I've owned Apple. Not quite 30 years, I've owned Amazon, and for more than 20 years, I've owned Netflix, and those have been beautiful investments. But I've also had things that cratered along the way. For instance, I bought Amazon because I'm an avid reader, but I also bought Borders, which went bankrupt, and Barnes and Noble, which massively underperformed the S&P. But it didn't matter because Amazon went up so much, 100-fold, that it didn't matter how poorly those other investments worked out. So I think that while indexing has its place, if you're a long-term holder of great individual stocks, as I've been with a lot of companies, those are probably the three best performing ones. I think there is potential there to be a stock selector, but just to hold that optimistic long-term view, even though some of the stocks you buy are simply not going to work out.
Let me raise another one. If we can move on, I want to show this chart on rising dividend policy. Keep going here. Next one. Okay. This is a statement, Jeremy, that you made in another book that you wrote on investing. Dividends are the critical factor giving the edge to most winning stocks in the long run. Now, I noticed that, Burt, you did not have any real discussion on the rising dividend strategy, or at least I couldn't find it in a random walk. But Jeremy, you make a big point about this, and this chart actually demonstrates that dividend risers outperform the market. So maybe, what do you think of the idea of improving on the index idea by stressing rising dividend stocks, an index that just invests in those? Would that be a good strategy?
Well, my own research and many others, we talked about, is there a value? Is there worthwhile to do a value tilt? I mean, Warren Buffett certainly was a value investor, and very few value investors the last 10 or 12 years have outperformed the market. Almost none of them by the traditional criteria. And that includes most of the high dividend payers. Now, there are the so-called aristocrats that have never lowered their dividends. They've done a little bit better. In the long run, we have the databases that go back to 1926 on the CRISP data. It's almost 100 years. And you do find that the dividend payers have outperformed, but a lot of that outperformance basically ended in 2006. But, since the financial crisis, it's been the worst performance of value stocks versus growth stocks in history, and he can by a big margin. We thought we saw a reversal last year, and now this year, again, the growth stocks have taken up the gallop again. whether that can be sustained, I don't know. So, but I do like the dividend payers, their value. I would add share buybacks because, the only reason we have, a lot of the reason for buybacks is exactly the tax reasons that Alex was talking about. Get the money back to the shareholders in a tax exempt way, and that's by buying back your shares. Now, the government, as you know, has just put a 1% tax on buyback. Now, that's a kind of a back of the envelope way of slightly increasing the corporate tax. If you do a buyback, it still hasn't persuaded a lot of people to go to dividends because dividends are taxable at full income rate. But it does tilt a little bit towards buybacks. And my recent research in 6th edition shows that those that do buybacks do really well. And if you combine dividend yield and buyback yield, you've done very well also. So the tax system plus options has shifted the story a little bit towards getting wealth back to the shareholders, and those that do get it back to the shareholders, counting those two together, do seem to have a long-term edge.
What do you think of, if we could talk a little bit about government policy, how good is our country in terms of how investors are treated? The capital gains rate was very high and then went down to as low as 15% long-term. Now it's up to 23, 24%. The Democrats want to raise it. They want to impose a transaction tax on every security that's traded. They don't like buybacks. They think this is just a greedy thing for executives. What would be your ideal tax system? Do you like the Hong Kong model that basically exempts interest, dividends, and capital gains so that capital can flow everywhere? Should there even be a capital gains tax? What's your opinion, Burt, on the government policy toward investors these days? Including, by the way, required minimum distribution. Is that a good idea?
I think the government policy in general is favorable to investing, and it's favorable because unrealized capital gains, and this is what Jeremy's been talking about, the unrealized capital gains are not taxed, and I don't think they should be. But unrealized capital gains are not taxed, and at least under current law, if you want to give your stocks away, you are able to do that without a capital gains tax. And in your estate, the valuation is then increased. The basis is increased to the value on the date of death. So I think in general, we have a relatively favorable situation. I'm not sure that I particularly like the fact that there's a difference between the tax on dividends and the no tax on unrealized capital gains. I'm not sure that anything like that is something that's particularly helpful. But I think in general, while there's a lot of complaint about our tax system, I think in general that the taxes on capital are reasonably favorable. And I would absolutely not like to see a change that would make unrealized capital gains taxable, as certainly many people on the left have suggested.
Jeremy, do you think that that just because you sell one stock and move into another stock that you should be penalized by paying a capital gain?
let me follow up. I do think dividends are unfairly taxed. The corporation pays tax on income, pays out that income to individuals, then get taxed. It's a double tax on dividends. I've actually advocated, and I think this goes with all our stories of long-term investing. If you have a policy of reinvesting your dividends right back into shares, and every brokerage firm will do that now for you automatically. Didn't used to happen, but you should be exempt if you reinvest it, because then you're on par with the person that gets those, untaxed on unrealized capital gains. If you want to take them, fine, then you'll be taxed. But if you don't and want to reinvest in, which many people do, it seems to be unfair to be taxed. And I think, therefore, we double tax the dividends. We should try to put those on the same par, with that untaxed capital gain. So, I mean, that is one, I think, basic situation is we shouldn't double tax dividends the way we do at the present time.
The other issue that is in the news a lot is ESG. On trying to focus this attack on fossil fuels, on oil and gas companies, causing major hedge funds deciding to, or pension funds, they're not going to invest in oil and gas companies or coal companies or tobacco companies. And by the way, that was the biggest shock reading your book, Jeremy. You named the number one most successful stock in terms of return on investment in the 20th century. And it's a real shocker. Do you remember what that stock is?
Philip Morris.
Philip Morris.
Philip Morris is the number one return, beats every stock that has that 100-year record, and most of it is because it was a real deep value stock during the litigation. And again, let's go to Burt's dollar cost averaging. Those who kept on putting money in or reinvesting the dividend yield was 10 to 12%. And, you kept on putting it in. And finally, when it recovered, when the litigation was over, even though it paid out 300 billion, which at that time was huge, you ended up beating everyone else. Actually, Gibson, Stone, and Mars have actually shown that so-called sin stocks, liquor stocks, tobacco stocks, and all those have actually outperformed the market long term. Yeah, ESG. I do have a chapter in my 6th edition, a new chapter on ESG. I try to be as neutral as possible.
Yeah, you're actually pro. You were pro ESG. You said it outperformed the market, but now it's underperforming. So,
yeah, well, no, I said there was one chart about if you could pick those that became, you thought would be ranked the ESG. I actually do state in there that an ESG portfolio in general will have an inferior risk return trade-off to a straight capitalization weighted portfolio. But if you get utility out of saying, I don't want to own Philip Morris or all the rest, I don't care if I fall short. Well, an investor has to make his or her own decision on that. But I do definitely say that will happen. Now, there is a climate risk hedge. People, it's called brown and green stocks. And is it a hedge against climate shifts and your utility on climate shifts? So there's some theoretical basis for using those as hedge stocks against some of the others. And that the E part of ESG has some validity. The SG part, I think, is a lot of mush, in my opinion, if I may use that word, and can be manipulated so easily that I'm not really sure of its value at all.
So, Burt, what do you think of how politics have now entered? You can't just play the market. Now you got to talk about the political side of these things. Can't we just invest and invest where we want to? But no, we've got to be concerned about ESG or what have you.
Well, I'm not a fan of ESG, in part because I'm not even sure I know what it is. and the rating agencies who give ESG ratings are all over the place. You know, the example I like to use, there's a Midwest utility, XL Energy, and there the ESG raters all don't like it because it burns coal. But it's also a utility that has given much more investment to wind and solar than any other utility. It's the only utility that have suggested they will be carbon neutral by a date certain. So is it good because of its investing in solar and wind, or is it bad because it's burning coal right now? There's just no way that you get particularly good ratings, even on governance. One rating agency says that Apple has the best governance in its industry, and another rating agency says it's got the worst. I think I like Jeremy's word mush. I don't think there's anything to these, and to the extent that companies that appear to be, quote, good companies get a boost in their price, then in the future they will have a lower rate of return, not a higher rate of return, although they may be okay when people are buying into them. But in the long run, I think it will be a good way of underperforming. And I go back to what I have believed all the time, and that is just buy a broad-based index fund. And let me give you one other reason. The ESG funds are very expensive. It's a good business. The amount that is charged by the investment manager, the expense ratios are far higher for ESG funds than they are for broad-based index funds and ETFs, which now can be bought at 1, 2, or 3 basis points. So it's basically a very expensive way to invest. And let me just make one other comment. I think any of us who talk about the stock market need to be very modest in terms of what we think we know and what we don't know. But the only thing that I am absolutely sure about is that the lower the fee that I pay to the purveyor of the investment product, the more there will be for me. And you had a picture up earlier about my dear departed friend, Jack Bogle, who I think put it the best when he said, in the investment business, you get what you don't pay for.
That's a great line that I'll use in the Maxims of Wall Street. You know, it's funny because I remember, this was probably 15 years ago. I went up to you when you came to Columbia University, and I was teaching there, and this new mutual fund had just come out. And I was very excited about it. I thought, oh, wow, this is going to be a big winner. And I ran up to you and I said, well, what about this fund? And you asked one simple question: what's the expense ratio? And when I told you it was over 2%, you just shook your head and said, this will not be a winner. And you were absolutely right. You were absolutely right. So Vanguard is quite a breakthrough. You know, the 1970s was really an incredible financial revolution where you had the commissions that were freed, that, you know, the market was allowed there. You had the options market, call and put options that developed in the 70s, the index fund and so on. And by the way, Jeremy, I see you still have that quote from Peter Lynch where he says, you know, I agree with Warren Buffett, the futures and call option, the option market should be abolished. I mean, you don't really believe that, do you?
No, I think that, I think that, you know, Buffett has a lot of words of wisdom, but he has a lot of mistakes. I mean, I think, you know, he has been saying that he thought that futures and options and what did he call them? Instruments of mass destruction.
Financial weapons of mass destruction.
Weapons of mass destruction, and they've proved nothing like that. Now, the only time where there was a blowout, the 87 stock crash, the portfolio insurance scam, I could call it, that blew up there in the very early days, really, of it. I mean, there weren't even ETFs at that time; it was just the futures. But that was very separate. But since then, despite everything that's happened, we really don't see any volatility. I remember people when working with Wisdom Tree and I with ETFs, they said, "Oh, ETFs are going to blow up. They can't stand any stress. Wait till the next bear market. They're going to be gone," and no such thing whatsoever. Now futures also are now. Of course, we have these one-day options, and a lot of people are wondering about what those might bring. But all these innovations have really not changed the basic character of the market. So I think stock index futures and all the rest can be a very good instrument to help you adjust margins, sometimes in a tax efficient way if you want to adjust your allocations.
So
let me just add one thing about the options market. Suppose that you have something that's a real winner, and you are really worried about it. For example, suppose you've got a big holding of NVIDIA, and you sort of say, well, look what happened to Intel 10 years ago. Intel was thought to be invincible, and Intel is now an also-ran. What could you possibly do? You don't want to sell it and pay a capital gains tax. One of the things you can do with the options market, and I think it's a very sensible strategy, is to write call options against your holding and be able to then turn a holding of NVIDIA common stock into an asset that is actually providing continuing income.
Yeah, that would be an excellent strategy. So I agree with you. I think the options and futures market play a very positive role, especially for hedging. It's not just for speculation. So we haven't mentioned crypto or Bitcoin and so forth. Does that have a future? What's your take on that, Jeremy and Burt?
Well, my own feeling. Go ahead, Jeremy.
Okay, thank you. I added Bitcoin. I try to take I own none myself. I try to take a very neutral view of it. I talk about, I do think there are a lot of imperfections in our money and banking system that Bitcoin could fill. 9 to 5 transfers, no transfers on weekends, international transfers, way overpriced. This is I think it spurs the banking system to get a much more efficient currency. I've been a big critic of our current credit card system, which costs consumers hundreds of billions of dollars a year and shouldn't. But I also think that it was oversold as an independent asset class when its correlation with NASDAQ was like 0.95. And it has never taken off as a money anywhere, really. Whether it might in the future or not is yet to be done, but it certainly has not. So I'm not going to be as negative as Charlie Munger. I don't think anyone can be as negative as Charlie Munger.
So, Burt, what's your feeling?
I mean, I'm not going to be as positive as Sam Bankman-Fried was. I mean, you get the whole spectrum, right? I see that I think we can have a much better transfer system in the U.S. and banking could be more efficient. And I hope it spurs competition to do that. But it's got it certainly hasn't taken a foothold in terms of being a separate, real distinct asset class with independence, or taking a foothold at being a monetary unit of exchange.
Yeah, but Jeremy, let me jump here and
Yeah, go
ask.
ahead.
You mentioned in the latest edition of your book that no asset in the history of the world has appreciated as much in as short a
Right.
time as Bitcoin has, and I would happily concede to the libertarians that there are uses for Bitcoin that the current banking system don't fill. The problem, of course, is this: there's no way to independently value other than the market price. But how do you determine whether the market price is overvalued or undervalued? It seems to me that it's the biggest asset bubble of my lifetime, and that despite the fact that there are some uses for it, there's certainly no broad adoption of it, and there's no way to value the currency independently of the market price. And so why would someone invest in it, given that it's up 10,000 fold in the last few years? So that's my question. Is the valuation question makes no sense.
Well,
Burt, what's your opinion? Let's have
count
Burt
me
get in on this.
as being very negative on Bitcoin. I certainly agree with Jeremy that we have a payment system, particularly an international payment system, that is terribly inefficient, and there's a big need for new ideas, for innovations, and that they will happen. But I don't think Bitcoin is it. First of all, it's really useless as a currency. I don't want to use Bitcoin to buy my coffee at Starbucks when I don't know from day to day how much it's going to cost. A currency that fluctuates 5-10% a day is not a useful currency. Now, where it is useful, and I will grant you, where it is absolutely useful, is that it is somewhat harder to trace than what I might buy with my regular credit card or with writing a check. So that if I wanted to sell you some cocaine, I might want to have the payment in Bitcoin, where it might be a little harder to trace. But precisely for that reason, this is not something that governments all over the world are going to allow to happen. And I do not see Bitcoin as the future of currencies. I think it is definitely a bubble. That doesn't mean that I have any idea when it's going to end. And Bitcoin could be $30,000 today. Would it surprise me if it was 60,000 next week? Wouldn't surprise me at all. And this then comes to what's also a very important point about the unpredictability of markets. You know, we know after the fact about bubbles and how much they have expanded. But one ought to remember that when we think about the dot-com bubble and we think about who knew about this, and the person who actually coined the phrase irrational exuberance was not Bob Shiller, it was Alan Greenspan. And it was Alan Greenspan in a speech before the New York Economic Club who looked at the markets in the late 1990s and coined the expression irrational exuberance. And you might say, well, sure, you see, it was very clear. Alan Greenspan knew the dot-com bubble was going to end. But what people forget is he made that speech in 1996, and the market continued to rise until February of 2000.
5 more years. Yeah.
And if you had bought the market the day after Alan Greenspan's speech, you made an enormous amount of money. You know bubbles, you know how much they expanded only after the fact. And so while I do believe Bitcoin is in a bubble, would I ever think of selling it short? Absolutely not, because it could be 20,000 next month. It could be 10,000. It could be 100,000. I have no idea, and we will never know until the whole thing collapses exactly what the extent of the bubble was.
Now, our time is short here, so I do have one final question to ask each one of you. And since you've been on Wall Street for 50 years or more, the question I'm going to ask is, what is the most important lesson you've learned in life? It could be on finance, or it can be just a general view. So while you're thinking about that, I did want to ask Alex if he had another burning question that he would like to ask before we close.
Yeah, we've talked about stocks for the long run. Obviously, if you're a young person and you have decades ahead of you, that's the place to be. But none of the four of us here are spring chickens, and we don't know how many decades we have ahead of us. What I would be interested to hear from both Burt and Jeremy. What is the long run, and what do you say to people who are in retirement who are saying, yeah, I realize it's the best performing asset class, but I don't have the time that I used to have? What would you say to them?
In the long run, we're all dead.
It really
right?
depends upon what you want to do with your money. If you are perfectly capable of living your life and doing everything you want without having to sell your portfolio, and you are investing your portfolio not for yourself, but for your children and grandchildren, that's the long run. And then an all equity portfolio, or a major, 90% equity portfolio is what's right for you. But if in fact you're not in that situation and you're counting on your assets to fund your living expenses for the remaining years of your life, and you're taking required minimum distributions, there, I think, is the case where I am absolutely a bond market investor today. And so I would make sure that you work to make your dividends as you get into retirement, not reinvested in stocks, but reinvested in 1-year treasury bills. And I want the amount of your RMD for next year in a 1-year treasury bill at 5%. I want your RMD for the year 2025 to be invested in 2-year treasury bills. There is where bonds will make a real difference, is what you ought to do. And fortunately, at least today, you can in fact get a positive rate of return with bonds, which you couldn't do with the crazy monetary policies that we had a couple of years ago, where we were flooding the economy with money and making interest rates fall to zero. That was the time to avoid it. But today, I think this is what you need to do if you are in retirement and you need that money to live on.
Great. Jeremy, you have a short answer?
Well, I mean, clearly, I just want to warn people. It's not really a warning; it's a good factor. Life expectancy keeps on going up and up. If you're a healthy person at age 60, you have 25 to 30 years left. And look at Burt, and maybe much more. And that's the long run. So don't think once you retire, hey, I've got to go to the bonds. You still have some long-term investing in you. And just keep cognizant of that.
Great, thank you.
Absolutely.
Well, we're short on time, so I want to go back to a more philosophical question. You've both lived long lives on Wall Street and in your personal lives. So, in your choice of what do you think the most important lesson in life that you have learned? So, who would like to start?
I'll be happy to start. And for me, it's modesty. It's to realize the things that are unknowable, the things that you won't be able to control. You can't time the market. Don't think that you can. You can't pick the right sectors of the market. I'm always amused. I'm a watcher of CNBC. Jeremy's on often making very good points. But when you think of what the people on CNBC were saying at the beginning of this year, well, avoid tech. You clearly then want to be in value stocks. You want to be in oil stocks. You want to be in bank stocks. And of course, the experts had it all wrong. You can't pick the right sectors. You can't pick the right stocks. Realize what you know and what you don't know, and default to have at least the basic core of your portfolio in index funds. And I think in stocks for the long run, reinvest the dividends. You want to take chances around the edges, fine. But be modest in terms of what you know and don't know. You can't time the market. You can't pick the right sectors. You'll never pick the right stocks all the time. Do it around the edges. Don't do it for your whole portfolio.
Well, thank you, Burt. That was good advice, and especially for governments, always trying to pick the next sector, right, that they can promote.
Yep.
Jeremy, you have the last word.
Well, I agree. Hubris. You can be on a roll, a streak, and then you think you know everything. And then reality hits you, and you realize no one knows everything. I remember January 1st being asked on CNBC, what do you think the return this year? I was one of the few positive. I said 10 to 15%, but I said, I think most of it's the second half of the year. Well, here we are, 15% in the first half of the year. Just to show you how different it is from what you can be. And I think let's talk about, you got to be thankful for what you have. A lot of people have a lot of good things that they don't appreciate enough during their lifetime. And you should think about that while you're living.
So let us thank again Jeremy Siegel and Burt Malkiel. I'm reminded of a quote from an old Maori saying, which says, "A noble man cannot be lost in a crowd." And I think we can apply that to our two guests today. Thank you, Jeremy. Thank you, Burt. And thank you all. We're very excited about FreedomFest coming up. And remember, we have autographed copies of both the latest edition of Stocks for the Long Run, 6th edition, and Burt Malkiel's 50th anniversary edition of A Random Walk Down Wall Street. Those are coming to subscribers to my newsletter and so forth. They get first dibs on the first 200 copies. And if anybody signs up for for a newsletter at FreedomFest, they'll get a free copy right away. So again, thank you both for this hour plus, and God bless, and thank you again.
Thank you.
Thank you,
Mark.
Alex.
Thank you. Thank you, Burt. Thank you, Alex.